Okay. Well, welcome everybody. This is the Better Bookkeeping webinar, the 5 tax mistakes new business owners make and how to avoid them. So we're gearing up over here, just giving it a second for everyone to come in. So Evan, why don't you introduce yourself and then I'll introduce myself and we'll get rolling.
Sure. So I'm Evan, happen to also be Mitchell's sister, but I run the COO of Better Bookkeeping, run the day-to-day, and we work with a lot of small business owners who have all these questions that they want answered. So we're going to try and answer as many of those as we can today.
And if you get on a sales call, you'll be on with Evan. If Yeah, Evan runs the show over here and has a tech background working for a couple of companies that have been acquired by Google and Comcast and all these, and then she's decided to come small business with me, startup. So, yeah, I'm Mitchell Baldridge. I'm the CEO and co-founder of Better Bookkeeping. I'm a CPA and a financial planner. I may or may not be your CPA or financial planner, but we'll get to that in a second. But so ultimately, we're here, yeah, to talk about kind of common mistakes business owners make as they set up their business, or oftentimes as they just run their business for a while, and how we try to help folks get set up the right way and think about things a new way. I think we've probably turned the chat off, but we have the Q&A on, I hope. And so you're free to hit the Q&A button and ask a question at any point, and we'll do our best to answer them all. And so let's get rolling.
Yeah, we did go ahead. I'll let you use our caution, do our
Oh
caution.
yeah. So this is my lawyer made me write this slide. And like I mentioned, like this is we're here to give our best advice, but it's somewhat general advice by its nature. Use safety when implementing tax strategy. Seek a professional. Again, these are common things that we help our clients think through, and these are general ways in which we think through them. And you know, you use this to the best of your abilities, and we'll get into more advice about seeking professional counsel, but we recommend it.
We did a webinar end of last year. One of the big questions that kind of came out throughout the webinar, through our little QA, were really around entity types, and we got a lot of questions there. So this was a big one that kind of popped up. So we're going to do a little bit of a deep dive on this one, and then go through kind of a few more. But this was one that, and if y'all have questions as we go, we have Derek, who is our senior manager CPA at Better Bookkeeping, in the wings answering your questions. We'll be bringing anything that we want to kind of talk more about live to this conversation, and so keep the questions coming if they arise for you.
So yeah, this webinar we did in November, the title, the hook was, kind of the worst conversation I have with clients in February is, hey, we can't you were all messed up last year and it's too late to fix you. So here we are in February, and while that's true, there's no time. The best time to plant a tree is a year ago, but the second best time's today. So ultimately, yeah, one of the principal things that goes wrong, or that clients are, I would say, under optimized, or in the best case, or heading towards a freight train in the worst case, is entity type, entity selection, and it's something that we focus on for every client as we get folks onboarded and set up into Better Bookkeeping. And I mean, with Better Bookkeeping, our primary client is like solopreneur, small business owner, startup, early seed stage VC startup. And so there's no like in accounting, the answer is always kind of it depends. And so there's no right answer if you say, hey, should I start up an LLC? And that, so the answer is, so the problem is my business is taking off. I'm busy. I'm trying to get to work. I'm trying to, serve my customers and keep my people happy and get payroll paid and pay my bills and collect my invoices. And I never really thought about this. It just got away from me. And so, what we always do, I mean, sometimes people don't even have an LLC or they're not even incorporated. They're just running out of their checking account and a Venmo, and they're off and running. And look, that's great. You got to start somewhere. And frankly, a lot of people spend more time than they should early on. You're either the type of person who doesn't take action because you're spending so much time trying to plan what you're going to do 4 years from now when your business is really taking off, and it just can never even get there because you can never get on the road, or you're the kind of person who looks back 4 years and goes, "Holy smokes, what happened? I should have maybe taken a minute to plan this and get set up the right way." And so, the folks that come in, they're either this sole proprietorship, they have a DBA or they have a checking account, or they're just running a Venmo, or they're, haven't thought of anything at all, or they've gone into, LegalZoom and set up an LLC, or shoot, they hired an expensive attorney and set the whole thing up the right way. I mean, we work with all kinds over here. And really, a lot of times we end up telling folks, especially by the time they've reached the stage where they're like, hey, I need outside bookkeeping, I need outside help, I'm making 250,000 to $2 million of gross revenue. We say, hey, you should have an LLC. What is an LLC? It's a legal liability company. It's a entity kind of domicile outside of your self, with the state, that gets registered. That's a separate entity. Evan, is this all making sense?
Yeah.
Yeah, good. And so then this LLC can be taxed a bunch of different ways. It could be a C corporation, it can be an S corporation, it can be a partnership if you have a partner, or shoot, the LLC can still just kind of be disregarded and flow through to your personal return, but at least you have a little bit of legal protection, or some kind of barrier between you and the person. So, people do LLCs for a couple of reasons. One is legal protection, that, hey, if there was an accident or an issue or a bankruptcy or a whatever, that there would be this layer of protection, this limited liability. And that's for the lawyers to think about. I'm a CPA, so and I'm a tax CPA, so mostly I start thinking about LLCs for the tax advantages. You know, for LLCs to really have this corporate veil, they call it, this layer of protection, they have to be set up the right way, properly maintained, properly registered, and you should work with a good attorney and keep that hygiene up, right?
So I glossed quickly over the first slide. Mitchell was kind of alluding to this with the sole proprietorship. So this is when it basically just, you do your own thing. You haven't really set up the LLC. So we kind of move into the more formal, which is you wanted to just go in and create a company. And we see a lot of clients just come in and say, I have an LLC. I don't really know what I'm doing with it. It's there. And we always ask, do you have a bank account? Have you done all the other fun stuff? But this really starts to separate. You just have a hobby that sits on your 1040 to now you have a company that sits on your 1040. And I think this is kind of step one for most of the folks that are coming in and they're starting fresh. We see all, as Mitchell said, lots of different types of companies at Better Bookkeeping, but more often than not, this is where people are when they walk in our door and they say, I started a company. Now what do I do?
Yeah, I started a company 18 months ago and just kind of went for it. And now it's, February 11th and I got to go get my stuff done, or I got to go get my taxes done, or I'm going to be out of compliance. And so, yeah, when somebody starts up here, we really just start to look at what business is this? Does it own property, or is it a consulting business? Does it have multiple owners or a single owner? Is it, you know, what is the trajectory? What is the end goal? Is it going to sell, or is it going to sit there and cash flow forever? Is it kind of a management company that's meant to serve another business, but serve the owner's interest in another business? That, there's a lot of questions that we try to sift through to then go, oh, okay, well, it sounds like this should be an S corp because it's asset light. It's mostly consulting income. You own 100% of it. You're never going to sell it. It's really designed to take money in and pay you out. Or this should be a partnership because you bought a property in it and you own it with a bunch of other people, and you have reporting requirements to give everyone their fractional interest of the activity, and you have the accountability to your partners of making sure everyone's done everything the right way. And then I mean, you'll then even we start to kind of take the separate interests in a business and start to layer separate entities to take on certain functions of the business. The bigger the business is, the more complicated it can get. But again, like, you don't want to own property in an S corp maybe because it's tougher to get the property out of an S corp, or you don't want a partnership because you don't have another partner. Or there's all these kind of things about every one of these entity types that I start to think through as I look at somebody's business. And again, that's the first place we start, is like, um, yeah, you're the mistake people make. They don't have the right entity type for their business. One thing about getting it done kind of on the earlier side, the downside of going in day one and trying to think this through is you may not know the future of the business. You might. I mean, you might be going to raise $4 million to buy a $10 million building, and you have a pro forma and it's just going to happen and you need a partnership. But you also may go, hey, this might take off. This might not take off. I might hire these people. I might not. And so sometimes you can just set up an LLC and wait a little while before you make an election or before you kind of lock in everything too much. But if you get too far down the road, you start to run out of options. Also, if you make certain elections, like if you elect to become an S corp, you can't really unelect it. So you have to be weary about kind of matching the entity structure to the needs of you and the business.
So taking like a quick pause and thinking back to the different things that were on the first screen. So we talked about having basically you're just making money. You've never registered for anything. Then you go out and you register your LLC. Maybe you decide to get a partner. So that's where this kind of partnership, if there's more than one person that owns an LLC, it's a partnership, requires you to file a separate tax return. There's pros and cons to it. We get questions about this all the time. One of the biggest challenges we see on the partnership side is, especially being a small business owner, is you want to be able to put expenses on your partnership. You want to put, your home office expense or your car expense or things like that, that you want to run through your business. You got to go get sign off from your partner or partners. So there's different layers to think about when it comes to the right. And frankly, a lot of times we will option, and clients will get multiple businesses out of this whole thing, the more complex their worlds get, just to try and make sure we're maximizing tax savings. So specifically around partnership, I don't know if there's anything else to add. I mean, we're talking about QBI. We love talking about QBI because it's a big area for us, but it's harder to optimize. It's harder to allocate expenses, things like that. It just adds a little bit of complexity, but if you have two partners, you need a partnership.
Yeah. Or do we flip into S Corp next?
We go to
Yeah.
C
So
Corp real quick, and why don't I go to
we,
S Corp, then we'll go back to C
yeah,
Corp.
yeah. Okay, fair enough. So then, like, if you have two partners, you need a partnership unless you want an S corp. So the LLC, if you do nothing and you own 100% of it, just defaults to sticking on your Schedule C, almost like you didn't have an LLC. It just becomes disregarded. You just still file one tax return, and you file all your business activity on your personal tax return. Well, if you have a partner in the business, that they own some stock the way you own some stock, or some units, as it were, it defaults to being a partnership, which just is a separate tax return where you line out the activity of the business and the shared capital and shared debt and shared profit and loss, and then each partner gets their own K1, which is a sort of a split up indicator of what your share of the business activity was as a partner. Well, you can also make an election whether you have a partner or not for this LLC to be an S corp, and an S corporation is something a bunch of our clients use out there because it allows you as a business owner to separate the business activity and the income of the business from your activity and involvement in the business. So in a partnership, if you're a partner, you're not supposed to pay yourself a salary. Whereas inside of an S corp, you kind of have to pay yourself a salary because the pass through dividends, or the earnings that aren't paid to you as an owner as salary, pass through the business and aren't subject to employment taxes and aren't subject to kind of additional Medicaid, Medicare. It just passes through like business income. So then with these businesses, you're allowed to do something called take this deduction out there called the qualified business income deduction. In 2017, the Tax Cuts Jobs Act was passed, and they brought down the C corp tax rate, which we'll talk about in a second. But then they threw a bone to these small business people and said, "Hey, we just took the tax rate from 30% to 21%. What we're going to do for you is give you this 20% deduction on all of your flow through business income. But if you make more than $400,000 as a family or more than $200,000 as an individual, what we're going to do is limit it to either the assets you have in the business or the payroll the business has." And so a lot of times, and we'll get to this, we spend a lot of time and effort trying to help business owners pay themselves the right amount in the right way. So in the S Corp, you got to spend a lot of time thinking about that. So you have to make sure the business isn't going to be asset heavy. It can't have foreign owners. There's some work. You got to file a separate tax return. So you got to make sure it's worth doing, because it's kind of like having a pet, or at least a finicky potted plant.
Yeah.
Um,
Thing about an S Corp is once you make that election, you can't really
yeah.
unravel it. So we do make that recommendation for a lot of our clients, and most of our customers have an S Corp in their portfolio of businesses. But we always caveat, like, you can't undo this. Once you make the decision, it's great. That's why we a lot of times will say, hey, what's your, this is your S Corp, this is your S Corp, because it's
Mhm.
still the money that is earned in an S Corp still belongs to the person who owns the S Corp. I mean, all the
Yep.
money in a C Corp or a partnership, or gets kind of treated a little bit differently. S Corp, although it does require a separate tax return, you
You're free to
don't,
pull out the money kind
yeah,
of
it's
whenever
yours.
you need to. Yep.
One question we just got is, you cannot or you should not own assets in an S Corp.
So yeah, cannot own assets is kind of a misnomer. I saw that. An S corp can own assets. You can go set up an S corp and buy an apartment building in it. Not to get too like in the weeds, but it's just not a great structure for. Partnerships, you're free to contribute assets, distribute assets. Just assets can go in and out all day long. You can title a property into it, then you can distribute the property. You can kind of do anything you want inside the bubble of a partnership. With C corps and S corps, when you contribute assets into them, they're harder to get out because they have this concept of built-in gains. So if you contribute a building into a S corp and then it grows in value by $1 million, theoretically you would need to pay tax on the built-in gain of that building, but before you take it out. So not to get too into the weeds on it, and there's ways around it and there's ways of dealing with it, but it just is general best practice to not own heavy duty appreciating assets inside of an S corp.
Let's move on to, let's talk C Corp and then we'll go to our little case study.
Yeah, C corps we'll do it real quick, but most of our clients who are C corp clients have raised equity under a safe note or under kind of the general venture capital guideline practices. That the real benefit of the C corp is qualified small business stock exemption. That's why most businesses that are kind of moonshot businesses all structure that way, because if you put a $100,000 check into one of these businesses and it goes and sells, you can get this $10 million exemption out there. Or you can go get a big old exemption on the way out, and you can split it up a bunch of times with trusts, and so there's a pretty kind of known organized structure as to how these C corps work and why these C corps work the way they work. Typically, if you're just a solo attorney or a consultant, you're not going to do this. You're really going to do this because you're willing to pay double taxation. You're willing to pay tax at the corporate level and then an additional tax on distributions the whole way through, because the sale benefit of getting this exempted sale, being able to sell tax free, is such an attractive offer that you're just like, yeah, cover my eyes and go do that. And you have to wait 5 years to sell it. So folks out there try to get that done early.
So we talk a lot about why S Corp, and like we've been saying, we're big proponents of the S Corp. So this is a little side-by-side laying out a real case with one of our clients, but Mitchell, you can walk through it.
Yeah, we've done this so many times that it's like, or I've been an accountant out, working for somebody else or working for myself for 15 years now, and have just done this 1,000 times in my life, which is a person walks in completely underplanned. And if this is you can go do this. You do not need to go. You don't need to sign up with us. You're welcome to. We'd love to have you. But this is just the immediate like value is person walks in, they're completely underplanned. They haven't even thought about it. They're a doctor and they used to work for a medical practice, but now they work for themselves, right? And they're making $400,000, so $35,000 a month, and they have $40,000 of business expenses. So net they're making $360,000. Well, they walk in and they've done nothing, and for the last 3 years they've pretty much paid $30,000 of self-employment income. They've been paying a bunch of income taxes. They haven't had the QBI that's been out there since 2017 because they never knew about it. They never thought about it. They're paying $114,000 of tax on the $360,000. And this is just federal tax, but not terrible, but 31%. And so, what we're able to do just through structure, just through this S corp out there, and just kind of filing an election, moving some things around, setting up a payroll company, is they still had the 400,000 of revenue. They still had the 40 of business expenses. But what we do is say, hey, be an S corp and, excuse me, pay yourself a reasonable salary. Well, reasonable salaries kind of are in the eye of the beholder. I mean, the height of FIDA, FUCA, Medicaid, Medicare is what is it in 25? It's probably one Medicare phase out 2025. You know, or Social Security phase out 2025. It's probably about $170,000. 176, 100 is the base. So, you know, it kind of caps at 175. The lower you go with your salary, the less self-employment tax you're going to pay. You can see the difference between the 30,000 in the base case and the 23,000. That's some savings, but then also what we've done with that salary is we've lowered their income tax because they've been able to now maximize the qualified business income deduction out there. And you know, this works for uh, you know, lots of types of businesses, agencies and manufacturing and real estate and kind of there are certain businesses that aren't eligible for the QBI optimization deduction. CPA firms being one of them. That's too bad. But so you know, this is like one thing we do, and there are you know ultimately 100 things we do, but there are kind of 7 or 8 of these that are just in our like automatic playbook as we onboard clients, but kind of projecting forward where they are and where they've been, and then what where they could be in the future if they made a couple of tweaks and a couple of optimizations. This is a small example. Everyone always then goes, okay, great. You saved me, you know, in this example, you know, you saved me $25,000, $24,000. Can we go backwards and fix this? And you're like, not exactly. It doesn't work that way, unfortunately. So, you know, but that's okay. We just go forward and fix it from there.
So going into just FAQs, kind of quick hits of you
Sure.
go in the, do I need an LLC? As Mitchell said at the beginning, a lot of our answers to
It
these questions
depends.
are going to be, it depends, or maybe. But yeah, I think 9 times out of 10, we always say yes. So,
Ultimately, if you have a big enough business and it's growing and it's going concern and it's a meaningful part of your life, you're going to want the asset protection. You're going to want the liability protection. You're going to want the tax protection. And you're just going to want to run a real business at some point. You're going to get tired of running it out of your personal Venmo and you go, okay, it's time to grow up and just bite the bullet and get this thing going.
oh, a quick thing I get a lot.
Hmm.
A lot of times people will have a side hustle that they decide to go and they wonder, when should I make this an LLC? That's a big question. And then furthermore, when should I take an S election? We do talk about the S corp having the PETA tax because it's a pain in the butt. You have to set it's a separate return. You have to pay yourself a salary. You need a payroll company. There's a bunch of different things you got to do. So people who have other businesses or earn a W-2 and then have this business on the side, a lot of times think that they're not eligible to do an S corp. They shouldn't have an S corp because they shouldn't have two W-2s. And we do a lot of calculating for those folks and show them side by side why it still is beneficial to take the S election. So in many cases, even if you do have a W-2 or you're doing something else, or you have, other income coming into your household, there's still benefits for taking that S election. And you can always reach out to us at Better Bookkeeping. We can talk to you about that more, but it's something I get a lot where it's like, well, I'm not eligible for an S corp because I already have a W-2. And it's like, no, you can do it. It's fine.
Yeah, those people get into QBI optimization pretty quickly because they're already earning a solid, healthy income and then another income on top of it. And we want to get that organized and make sure that they can get that 20% deduction out there. The other thing people do who have main income, side income, is use the S corp for a really, really big, sweet retirement planning tool. You know, you can go set up your own 401k and load 50 grand into it and do it for your spouse and all that. And, you know, certain people who are really, really indexed towards saving a ton, it can be a really good tool for that.
All right, let's move on to our next topic.
Mistakes people make, commingling, mixing business and pleasure. Yeah. So, I mean, this is like we've built this, the entire way the software is built is that, you know, we have Plaid at the front end. So you connect your bank account and your transactions just start feeding in. And so obviously we are self-interested, and we go, hey, we want you to feed in pure business transactions or pure personal transactions for that matter. You can label the account that you connect business or personal, but what we can't do on our end and what no bookkeeper can do, and even, you know, 14 months later, if you're sitting on your couch with a glass of wine, like you can't even do it. Try to figure out what the heck was business and what the heck was personal. One of, you know, Evan, my sister and my mom's friends, one time talked to me at a party, and she said, "You know what I do every year? I basically take 2 days off of work, and I get out all of my statements, and I get two highlighters, and I go to the Black Walnut Cafe, and I sit there." And I highlight all of my business transactions and all of my personal transactions. And then I get out a calculator and I add it all up. And at the end of it all, it's easy. And you're just like, that does not sound easy to me. It doesn't sound like a fun time to me. And it doesn't sound very like, uh, or I guess it's repeatable if you spend 2 days every year doing that. It's, but I think she can go add up these statements 3 or 4 times and get a different answer every time. And we don't want our clients to do that. You know, our tagline, you didn't go into business to do your own books. Like that's not what we're here for unless you find that fun. But so, you know, we recommend our clients set up the LLC, set up a bank account under the LLC, go get a credit card. If you love United mileage points, if you love Amex points, go do that. If you love cashback, you know, go do that too. Get the best system set up for you, and then just use it. Like, you know, this is my business credit card. This is my kid's haircut credit card, and never the two shall cross. Right. Um, you know, yeah. And so the problem beyond just it taking a little bit more time is you're gonna miss deductions. You're gonna, if you get sued and you go to court and you go, hey, this was an LLC and I'm protected, they're going to go, well, why were you buying your dog food out of your LLC? You know, you're just, it's unprofessional. So, and then, you know, yeah, you go get audited. You either create an audit because you missed something, or you go get audited and you're sitting there with this IRS agent across the table with a straight face going, oh yeah, but I took out all the Nordstrom purchases. But so just look at it this way, to like, if you're trying to explain all that to an IRS agent, you've already lost. So, you know, back to what I was saying, best practices, open a business checking account for one purpose, capitalize it. If you need to capitalize it, don't capitalize it. You know, I tell a bunch of people, I'm like, get a business checking account, put $10,000 in it, take your home internet, take your, you know, cell phone bill, take your Apple laptop, like start using that checking, start using that credit card for that. I just showed everyone my number. No big deal. No, and then you know, use that card for only business expenses. So I'll talk about Meow. I don't get paid to talk about Meow, but Brandon and Bryce have like they took a bunch of capital and built an entire neobank. It's a application layer on top of a bank, and I've really liked using it. You get paid interest on your checking, and you get like 2% cash back for swiping your card. To me, it's just the easiest, like no brain. I'm the return on hassle guy. I just hate uh, dealing with crap. So what I like about Meow is just your money sits in the bank and it just sits there and earns interest. You use your debit card, it pays you cash back. It's just like dummy proof. And now I don't have to worry about credit card points and treasuries and all this stuff. It's just like, is it like the most optimal way you could do it? No, but it's I don't have to think about it. So, and if you want to talk to us or hire us to kind of deal with all this for you, feel free. Betterbookkeeping.com. So, yeah,
Oh,
here are expenses. Like I'd mentioned some of them, but yeah, obviously all the salaries, benefits, payroll, rent, utilities, office supplies. One of my favorite parts about, or like why owning a small business is the best tax deal in America is that like I used to go to work. I worked for a CPA firm. I would earn a W-2. I showed up, I earned my money, I paid my taxes, and then whatever was left, I could go buy a car, I could go pay my cell phone bill, I could pay my home utility, my internet. When I became a business owner and I had a profitable business, all of a sudden the business expenses that it took to live my life became above the tax line. So instead of earning money, paying tax, and then buying that stuff, I got to earn money, buy that stuff, and then pay tax. So, you know, just home office stuff, office supplies, certain, a little bit of home utility, internet, backup internet, all of this junk that you need to stay in business, all is deductible, and some of it you needed before you were ever in business. So business travel, business meals, business mileage. Like, yeah, I had a lot of that stuff, and I didn't want to be accountable to my employer. I didn't want to take the business coffee and submit it as a reimbursement. Well, now it's deductible.
yeah, and better bookkeeping or any tax professional, any of those legal professional, all that stuff is expensible. It's funny when I have that call, I'll be on sales call and someone will ask me, so can I like expense you? And I'm like, yeah, I'm expensible. And it's always like a light on their face when they realize all the things that they're not expensing. And we talk about audit, we talk about all those things, but frankly, what I find more times than not is that people aren't expensing, they're just putting it on their personal life and they're not bothering to come back with the highlighter, or they're not bothering to go back, and then they're missing deductions. They're not doing the home office. They don't want to go add up all their utility bills and divide by 17% because that's the percentage of the home office in their house. Like, and so it just becomes it's the hassle versus the reward, and they're not willing to do it.
Yeah, so the meals are 50% deductible. The idea is that theoretically, I I don't get to deduct my meal. I do get to deduct your meal when we go out to eat. So James asked this, and then the 100%. If I throw a conference and there's food at the conference, I get to deduct the food. It's so they had 100% meals during COVID for a couple of years because they were trying to stimulate the people. They were trying to get people into restaurants. That's worth saying is like this whole tax regime is an incentive system at its best. It's a racket at its worst. But like the idea is, hey, we're going to give people bonus depreciation. We're going to give people 100% bonus depreciation because we want people to go out and buy American trucks, or we want people to go out and buy real estate. And so we're going to go put this incentive out there because we want people to spend money and go capitalize their businesses. And we want to give them a upfront reward for it. And, the tariff is the opposite of we want to disincentivize this behavior. So that's the tax system, if implemented correctly, can be a incentive system. And again, it drives everybody towards owning their own business eventually.
Okay. We're more than halfway through, and
All right, take a breath.
yeah,
Let's blow through it.
yeah.
Number three, paying yourself the wrong way. We talked a little bit about structuring salary, and this is something we think about for every client, every business owner, is how should the business owner structure their own salary to, one, remain compliant, and two, ultimately save the most on tax that they're allowed to do. The other thing, like one kind of little pro tip that we use is we use salary withholding as a tax planning tool. For a lot of business owners, if I'm this way, again, I'm lazy, or I just like things to be taken care of. I don't like the feeling of sending big checks to the government. That makes me feel sad. And so one thing I do is just like set my salary to literally like pay my 401k contribution, pay my healthcare costs for my family, and then the rest like just goes into the kitty as federal income tax. And then I use distributions as the tool to take home money. And so, you know, people call us all the time. I'm sure they call you, Evan, and they go, "Oh, so my salary's 100 grand. How am I going to live on that?" Or, and you're like, it's your business, it's your money. You're free to take all the money. We're just trying to pay yourself the right way so that you optimize QBI, pay yourself enough to, pay the appropriate amount of Social Security, FICA, Medicaid, Medicare, so that the government doesn't slap you. And then again, we use that federal income tax withholding or state income tax withholding as a tool to try to help people withhold the right way so that they can just go, oh, well, X is already paid in. So I can take a deep breath there and not have to worry about that.
I get a couple of questions about this when I get on calls with new folks. And a lot of times, sometimes I have questions because they'll say, I paid myself a salary of like of 100 grand. And I'm like, what payroll system did you use? And they're like, no, I just put it in my bank account. And I'm like, okay, well, that's not the same thing. If you didn't pay payroll tax, if you didn't withhold all the things that Mitchell just talked about, then you didn't actually pay yourself a salary. The other thing I get is, okay, I needed to pay myself $300,000 because I need $300,000, to live on. And it's like, well, you don't have to pay yourself all of that as salary. You can pay some of it as salary, pay some of it as the distributions. And the last thing I get a lot is, well, if I don't pay myself that money, if I don't take that distribution or I don't take that salary, then I don't have to pay tax on that. And that one I get a lot, which I think it's because people aren't clear between what is
A
retained
C
earnings
corp.
and, in
Yeah.
a C corp versus, so, and then they're very concerned about what bank account the money lives in, whether it's their business account or their personal account. And I have to just explain, like, it's your money, no matter what account it sits in. If it's an LLC, an S corp, it's your money. You're paying tax on it, so you should use it. Make sure you don't
It's
feel.
a pass through, and eventually, yeah, if you earn $1 billion next year in your C or in your S corp, you're gonna eventually have to distribute money because you're gonna have to pay taxes, and you're gonna run out of personal capital to pay taxes that for money you think is stuck in your business. It's not stuck. Yeah. Um, So the fourth mistake, you know, new business owners make, which by the way, the five mistakes new business owners make, the five tax mistakes new business owners make and how to avoid them, I freely ripped off from the great Peter Maluk, who said the five mistakes investors make. And I mean, it's all the same stuff. You're not planning as you go. And so really, for many, tax planning happens never or once a lifetime. Doug Boneparth on Twitter the other day joked that like, oh, I have to pay 1% on my assets every year. What, you just set it and forget it, right? And I said, oh, well, I have my tax plan from 2012 and it's still great, so don't worry about it. That the tax law has changed more in the last 10 years than it did in the prior 25 or 30 years. It changed in 1986, and then it didn't really change meaningfully until 2017. And then they're about to ram through a bunch of tax stuff this year. It's like this has evolved into well, even during COVID, the government used the IRS and CPAs and the tax apparatus as a vector to distribute government stimulus, and so I spent tons of time talking to my clients about PPP loans, PPP forgiveness, EIDL loans, ERC loans, all of these tax credits out there that kind of came through the government, again, using the CPA as a vector. And I mean, the tax system is evolving and changing, and everything's changing more than it ever has. And so really we try to work with our clients to say, every month you're going to get an email with your books that are closed, with your P&L and your balance sheet and your cash flow statement, and you'll be able to kind of see what happened with your cash and what has happened with your taxes, and kind of where those are different from one another. Every quarter, we'll give you a quarterly tax estimate. We'll say, hey, you paid $25,000 last quarter. You're going to pay another 25 this quarter. Here's how we're projecting your year. Do you have any questions? Is there anything big on the horizon that's going to change that we need to know about? And then annually, we kind of top you up and make sure that we're bonusing you if you need to be bonused, changing withholdings if we need to do that, or, and, doing planning and changing when you call us and say, hey, I'm getting married, I'm having a kid. Should I do a 529 plan? Should I want to save more for retirement? Like we just have those conversations along the way. And it's not a once a year thing. It's not a once every decade thing.
Yeah, we had a call earlier today with a new client, and they said, oh, my spouse just quit their job. And, that was a big, we were thinking about tax planning and what are we doing for, Q1 for them, and what are we gonna safe harbor, what's the strategy? And all of a sudden it just that makes a big difference. And that's going to make a big difference on our recommendations on how we play out tax for the whole year, amongst other things of should they go ahead and take an S election and on which business unit. And there's lots of different moving pieces, but we always try to stay on top of it. So you're not stuck paying a tax bill you weren't prepared to pay. And
Yep.
oh, with penalties because you didn't pay as you went. And sometimes people are fine with penalties, and I could put my money in the stock market and make more than I'd pay in penalties. And cool, that's fine. But I want everyone to know, at least what it looks like. At least you're aware of what's happening, as opposed to that being shocked by, a $40,000 tax bill that you weren't expecting.
Yeah, your cost of capital, what the trade-off is. Well, I had a real estate guy who forever just said, "Oh, I'll pay the penalties. Oh, I'll pay the penalties." And I said, "Hey, this is 8%. I just need you to know it's 8%, and this is a big number this year." And he was like, "Oh, yeah, yeah. I'll just pay the," because he realized, oh, that money's sitting in treasuries and it's earning 4.5, and it's paying 8 on the other side. This is a losing trade. So yeah, you have to just kind of re-underwrite all this stuff. And what we try to do is be one, the best thing we can do at Better Bookkeeping is give our clients like a view into their financials that they understand that they didn't understand before. And two, try to help our clients kind of re-underwrite their decision-making process.
Yeah, and we try to get everyone as close to as we can to the number. I mean, it's an estimated tax payment, but if you don't pay it, you are going to pay more. That's the bottom,
Yeah.
without any question. And we do keep it, we keep throughout the year making adjustments and make sure you're not overpaying. But you really, if you pay any kind of penalties, you pay anything like that, you don't get that back. There's no rollover of penalties that you can
Yep.
carry forward to the next year.
Yep.
Key dates, just real quick. I'm sure everyone knows these, but it's always good to remember Q1, get a little bit of a break, waiting for April 15th. But of course, if you didn't pay anything, if you didn't finish paying out your prior year taxes, those are also owed on April 15th. So just a few things to keep in mind. We have a calendar that is a tax deadline calendar that you can subscribe to, and it will put it on your calendar of choice. So it'll ping you throughout the year.
Do that little bit.ly deal. Cool. Um,
We love safe harbor. This is a big one.
so the IRS allows you to, if my total tax bill was $100,000 in 2024, going into 2025, I know I can pay 110%, meaning $110,000, and be safe harbored. Even if I go win the Powerball and get the $1 billion January or July 15th, I don't know anything except $110,000 until April of next year. Um, so if your income's constantly growing and your cash flow is keeping up with it, that's the easiest way to do it. Is just pay 10% more, 10% more every quarter. You still have to keep that kind of overhead threshold of what you're going to owe next April in mind. If I spend the whole billion, I'm still going to owe 300 million in or 400 million as it were in next April, even though I paid my 110 grand. But if your income's going down, the thing you can do is pay 90% of the current year tax. So if I owed $150,000 of tax last year, but I know I'm going to owe 100 this year, I'll try to have 100 paid in, or at least 90, so that I don't get in trouble in April, and so that I'm topped up.
And then there's what we normally do, which is we
Yeah.
provide quarterly taxes based on what we've seen in our system, what we've seen, people have actually earned.
Yeah, you sort of know, especially if things aren't changing over time. Like I'm a 30% effective tax rate person. And so every time I distribute $1, I need to have 30 cents sitting off to the side, maybe 35 cents. I'd rather be surprised and, be told next April that I have a little bit more money than I needed, rather than be trying to flip the couch cushions. But yeah, so, what we do programmatically, no matter what, is just say, hey, based on what you earned last year and projecting, or the last 3 months, and projecting your year forward to the end, we think you're going to owe this. So,
All right, last one.
all right. The mistake folks make is DIY. And so, look, I'm a barber. I'm telling you to get a haircut, but like, I don't do my own dental work. Yeah, I just don't do it. It's not a good idea for me anymore. So I go to the dentist. But like ultimately, this stuff's moving around. It's changing a lot. Um, I did a thread about this on Twitter, and someone replied to this thread and said, I talked to Chat GPT and set up my own S corp. And I'm like, well, that is fantastic for you. It's that Gell-Mann amnesia thing where, like, when I ask Chat GPT questions about things I don't understand, I think it's really, really smart. When I ask Chat GPT complex tax questions, I don't think it's all that smart. So it will get smarter and smarter. I will be put out of a job, hopefully one day, but we're just not there yet. So ultimately, the more complex your business is, the more specialized advice you're going to need from lawyers, accountants, et cetera. Um, again, I'm bullish on all this AI stuff, and I really do think it's going to come in and help regular folks have a doctor in their pocket, but not yet. So, yeah, these are just questions we get all day long of should I buy or lease a car? What can I expense? I'm buying this piece of real estate. Should it be in an LLC? Will X get me audited? Is Y normal for what is standard for my industry? Should I pay my wife? Should I pay my kid? Like the real question, I know I'm not doing this the right way. What should I do? Um, and the answer is always it depends. So, this is what we try to be here to help our clients do is just be someone in your corner. So, the big pitch, if you want to work with us, if you want help, uh, sign up. We're offering 50% off of setup fees. I mean, we've gotten all the way through 2024 at this point, so we can bring you on. We can give you a price to if you haven't done anything yet, we can catch you up all the way through the year and fix you up. If you've just need us to file your taxes for 24, that's great. If you're going to use your old person to file 24 and just need us for 25 ongoing, that's great too. We're giving 50% up off of setup fees, and yeah, if it looks like we can help you, we'd love to.